Everybody. Thank you for joining us today with the combination of Cherry Bekaert and Avalara's technology training session on how to reduce sales tax risk for your technology company. We will be offering CPE credit as part of this training session. In order to receive training, the CPE credit, there will be 3 polling questions that will be provided throughout the session, and you must attend for a full 50 minutes. For your notes, a recorded version of this webinar will also be available in about 1 week. It'll be posted on the Cherry Bekaert website. And you should be receiving a notification of your CPE certificate via email within about 10 days. If you do have any questions as the speakers go through this session, there will be a Q&A window that'll be available throughout the training. And feel free to ask questions as the training goes through the process. And our speakers will go about answering these questions in a timely fashion. And finally, at the end of the training session, there will be a short survey that will be posted addressing what your thoughts were on the overall training session and how the speakers performed. And with that, we'll go ahead and shift to the introduction to the speakers. And I'll be the first speaker of the day. My name is Chris Grimes. I'm a CPA CMI. I've worked with Cherry Bekaert Advisory, have been with the company for I've been in the sales tax profession for about 10 years and focused primarily on businesses in the technology sector. So that typically involves software as a service providers, on-premise software providers, just general services and hardware and things like that. But over my time of this last 10 years or so, I've helped many businesses get from help to them to address any of their historical and prospective sales tax obligations. And my colleague for the day is Diana. And Diana, please introduce yourself.
Sure. Thank you, Chris. My name is Diana DeBello. I am a senior product solution engineer here at Avalara. I have been in the sales and use tax automation space for well over 25 years. I have worked with companies like Avalara developing solutions to help companies collect, calculate sales and use taxes. In addition to that, I've worked in industry where I've managed the tax solutions for companies, making sure that they're calculating the correct sales tax and remitting those taxes. And I did do some time in public accounting where I assisted companies implementing their solutions. So I am thrilled to be here with Chris to talk to you today about sales tax risk.
All right, perfect. So now on to the agenda for the day. So Diane and I are going to be covering quite a few different topics today. We start off this discussion really with a holistic view, and then that holistic view is going to consist of a why are you here slide, and then going in through a case study of a client that I've recently served in the last couple of years. This showing that the whole process as to where a company begins, where they have very limited compliance focus, and then where the company ends in order to address any of their sales tax obligations. From there, after we end up going from the high level, we start getting into a bit more details, like what is each step along the way to make sure technology businesses are doing what they need to do to stay compliant. So that involves looking at a company's Nexus footprint, so where the filing obligations exist. How does a company source revenue? Is there differences in how you source services, software, tangible property, things of that nature? We also get into discussions about the actual products and services and approaches that can be used to make sure the right tax decisions are being made. And then we start getting into a few things related specifically to compliance, and that is basically managing your exemption certificate collections, automating the sales tax rate and tax determinations, and then the actual tax return filing process. All right, and with that note, we are on to our first polling question of the day. And just a reminder from a couple slides ago, we do only have about 45 seconds to answer these questions. So here's the opportunity to do so. Question 1 is, how did you hear about this webinar? So answer 1 or answer A, a Cherry Bekaert tax advisor advice. Answer B, an email from Cherry Bekaert. Answer C, an email from Avalara. Answer D, a friend or colleague. Answer E, a Cherry Bekaert alumni, or answer F, a social media post. So we'll give another 15 or so seconds for the responses to come in.
I saw
Then-
some great social media posts about this webinar, so that
Same
was
here.
yep.
Alrighty. Okay, it looks like we're about done. And we will go ahead and move on to the next slide.
Great.
All right. So the first topic of today, purpose and case study. So why are we here today? So frankly, there are all kinds of unique complications that arise with sales tax in the technology industry. They're all across the board. And some of those complications typically include identifying where a business is required to file their sales tax returns, what creates this overall obligation. Also, are my sales subject to sales tax? So a lot of people historically think of just sales tax as just really applying to tangible things. I go to the store, I buy some paper, I buy some pencils, something tangible you can hold in your hands. Yes, clearly going to be an obligation to collect sales tax on that. But it gets a little tricky when we're talking about the products and services. So sorry, the services being provided as part of a technology industry. Is on-premise software taxable? Is software as a service taxable? Are the implementations or professional services taxable? Lots of complexities when it comes to the actual products and services themselves. Other complications that include, how do I actually source the revenue? And what if I have users in multiple states? I provide SaaS. I have customers in Texas, Georgia, Florida. Do I source it to one of these 3 states? Do I source it to the headquarters? How does that all work? And then really, how do I manage the whole sales tax compliance function with very limited resources? How does it not eat away at a good chunk of my working month? So those are some of the complications that typically arise in the technology industry. And what our objective today is to provide you some insights on how to address these particular issues. All right. So this will probably be the slide that we've spent the most time on. It's a case study, and this has to do with, again, looking at a company holistically from being minimally compliant through going through the whole process of getting compliant and addressing sales tax going forward. So we'll start off with the company background. Company background of the company is Cherry Bekaert was providing federal tax and audit services to a company. This company ended up getting introduced to the sales tax team for just a kick the tires kind of call. Hey, how is the business going? What are you doing from a sales tax perspective? During that call, it was learned that the company has about $6 million in annual receipts. They provide SaaS. They have 50 remote employees scattered throughout the US, and they have roughly 160 customers, and they were only filing sales tax returns in California. So just based on that very limited amount of facts that was provided, had a good gut feeling that, likely there's going to be some degree of risk for this company. So what we ended up doing for guidance is, after getting engaged with the company, we ended up performing a sales and use tax nexus review to determine where the company's obligations existed. And through having all these remote employees and exceeding economic thresholds in certain states, the company actually had obligations in about 30 different states. So they were filing in one state, did have obligations in 30 states. So big difference, big gap here. High likelihood there's some additional risk here. So since we found out Nexus existed in so many states, we took next steps to say, okay, for all these states where Nexus exists, are your sales taxable? So the good news about software companies and service providers is this type of revenue is not taxable in every state. And as we went through that whole process, we did find out there were about 10 states that did tax the company's software, services, et cetera. And unfortunately, it resulted in an estimate of about $1 million in sales tax exposure. So what happened from there when we identified this? The good news, again, is even though there was exposure identified, there are steps that can be taken to mitigate this exposure, to reduce it. So one of the topics we'll talk about today is the sourcing of revenue. Many like software as a service companies just defer to a bill to location. So we did this exercise based on the bill to location. However, when we started getting more into the nuts and bolts and found out the basic contracts for certain customers of the business actually had customers located or users of the software located in jurisdictions that don't tax SaaS, we were able to reduce the overall exposure significantly just by taking a second look at the sourcing and how the sourcing actually worked. And the second part of this mitigation exercise really had to do with performing an outreach to your customers. If you have customers that are more of a sophisticated tax department, larger tax department, they may have the technical resources there to determine if use tax is due. So you may have customers that are self-assessing, reporting use tax. In addition to the self-assessing and just filing the use tax, which is the complement to sales tax, they may have been audited and paid this tax. They may have done a BDA. They may be exempt in their entirety. So if an outreach took place and we find out, hey, customers buying software for resale, customers in exempt entities such as a nonprofit and state and local government, which just to say those exemptions don't apply across the board. So just because you're one of those doesn't mean all your customers are exempt. Certain states still tax those customers. But they went through this whole exercise, and after completing the whole mitigation work, we were able to reduce the exposure from $1 million down to only $200,000. So still a sizable number, but much better than the whole $1 million where we actually started with. So with that $200,000 in exposure, we were able to assist with any historical cleanup through voluntary disclosure processes, get the company connected with Avalara to ease the ongoing compliance process. So we got the company, which is just one person basically managing the whole sales tax function, connected with Avalara. Avalara was used to determine the rates. Avalara is used to determine the products, the taxability of products and services. And it just makes it a much more manageable and seamless process going forward. So overall, some risk was existed, company's happy, and things are moving in the right direction. All right, so we're done with the discussion about the high level overview and whatnot of the case study. So let's kind of transition down to the more granular details. And from here, we'll hand it off to Diana to continue this discussion.
Great. That was a great story. And I think it's always so valuable to hear real life stories of how companies can have so much risk associated with sales and use tax. One thing I often say on these webinars is that sales tax is a pass-through tax. So if you do it right, it should only be the cost of administering that tax. If you do it wrong, though, you're going to be paying not only the fees and penalties, but the tax itself in a lot of cases. So it is critical to make sure that you minimize that exposure as much as possible. All right, so let's talk about Nexus. This is one of my favorite topics, although a lot of sales and use tax topics are my favorite topics. So there are different types of Nexus, and underneath the physical Nexus category, you see here that there are a handful of different things that could trigger Nexus. Now, there's only 5 listed here, but depending on the state, there could be 20 different criteria things that could trigger a Nexus for a company. But typically you look at people, places, or things that are located in the state, and that could trigger a Nexus for you. So things like offices or property, employees located in that state. Thinking about how you visit that state, whether it be to go to do work at a client or to visit customer sites. And then do you have third-party sales representatives? And of course, there's that ambiguous term of affiliate nexus. Affiliate nexus is what's going to be trigger nexus when you have a relationship with another company. So it's important to understand the contracts that you have with other companies to see if their presence in a state could be triggering Nexus for you. So let's move to the next slide and talk about the wonderful case of South Dakota versus Wayfair. I know a lot of businesses don't think it's a wonderful thing. This was a U.S. Supreme Court decision that was handed down in 2018. I hate to admit it, but actually was working in sales and use tax when Quill Corp was handed down way back when in 1992. So this was a very major landmark case for sales and use tax, and one that the states had been fighting for a long time. The states wanted to have the ability to have out-of-state sellers be required to collect their tax based on economic activity in the state. So up until June of 2018, the law of the land was a physical nexus requirement, although there were states that were getting into more technology related triggers for nexus, like click-through nexus. But this court ruling that was handed down in 2018, I'm sure you probably heard about it somewhere. Everyone's heard about it. South Dakota versus Wayfair. It allowed the states to pass their own laws to create economic nexus laws, requiring those out-of-state sellers to collect their tax. And the sellers then have the responsibility to collect that tax. So under the economic nexus category here, all the states that collect a sales and use tax have passed economic nexus laws. And then most of the states follow the original Wayfair thresholds that are $100,000 in sales or 200 transactions. Now, I will say that over the past few years, more and more states have been dropping that transaction count requirement. But it does still exist there. So think about it, even for small sellers. So say, you know, you're selling water bottles, you're selling these cups and you're selling them online. It's very easy to do 200 transactions of those in a quarter, much less 12 months. So of course the requirements do differ for those. So we can go to the next slide here. So with the transaction count thing, it's important to understand what a transaction is. And here we've included talking about subscription-based purchases. So do transaction thresholds, are they including the subscription based on the monthly subscription fee, a quarterly fee, or an annual? And if it's a monthly subscriber, does that mean that they have 12 transactions per year for each subscriber? So again, it's important to understand what the state's requirements are. And oftentimes the states don't have a lot of detail in the nuance that they provide or don't provide to describe those transactions. So the complexities in determining economic nexus are that there's usually a look back period. So how long has it been that you've done business to hit this threshold? So the states vary in how they look back. Some say it's the previous calendar 12 months, a rolling 12 months, a rolling 4 quarters. So of course the states are not consistent in what they do for that look back period. Let's add some more complexity here. So the types of sales, some states say all taxable sales or all tangible personal property and services, taxable services, or they'll say all sales. And do they include the marketplace sales? So think about selling on Amazon.com or Walmart.com. Some states will include those sales in those numbers. So the types of sales that are included in that count for that threshold does vary. Now the enforcement dates do vary as well. So when those rules were put into place and how far the state will look back. And then, of course, how related entities could impact those thresholds. So if you're using a marketplace, for example. Now, here's a chart that shows some of the states that include the exempt sales in the economic threshold. You can see the orange states are the ones that do include exempt sales. The blue exclude it, and then some split. So they have exempt services are excluded. So that gives you an idea of the complexity there when it comes to determining the economic nexus presence in those states. So now I'm going to hand it back to Chris to talk about some sourcing concepts.
Okay, perfect. All right, so on to sourcing. So first off, what does that even mean? What is sourcing? So sourcing is going to be how a business determines where sales receipts are to be reported. So for this section, we'll go over some of the challenges technology companies encounter and possible solutions when it comes to actually completing sourcing. So one of the first complexities has to do with the level of granularity required as part of reporting. Now, when you think of like state income taxes and things like that, just having revenue at a state level is generally enough in order to determine where the receipts are to go. But when you think about sales tax, we need much more than just the actual state location. We'll also need to get down to zip codes, counties, cities, and in some jurisdictions, even down to the actual street address. You may have instances in which you'll be in one jurisdiction, and on one side of the street, it's a 7% rate. On the other side of the street, it's a 9% rate. So in order to ensure that there's no underreporting or over-reporting or overbilling customers taking place, it's important to capture that level of granularity of data in order to determine the appropriate tax rate. All right, so how should sales be sourced for sales tax purposes? So sales tax is typically going to be destination based when you're considering it from the state tax portion, but there are also local taxes, and we'll talk about that in just a moment. Now, sourcing can be a simple process depending on what's being provided. If I am a hardware company and I'm selling keyboards and servers and things like that, it's just wherever I'm shipping the product. If I'm shipping it to a data center, if I'm shipping it to a customer location, if I'm shipping it to another business, wherever the product goes, that dictates where the sourcing takes place. But the complexities arise as you end up having software as a service, remote services performed. Do I source the revenue based on the actual location I am providing the service, or do I source the revenue based on where the actual benefit is received? So we'll get into discussing that further in the next few slides, but generally speaking, it's going to be where the benefits can be received, as long as it's a remote service. Now, I mentioned earlier that there are some nuances with the local taxes. So when I'm going to pay a sales tax rate, say I go to, we'll say Texas, for instance. Texas is going to have a state rate of 6.25%. So whenever you collect sales tax, report it to the state on one sale, 6.25% will go to the state. And then whatever additional rates that are associated with the jurisdiction in which the revenue is sourced will go to the localities. Now, the confusing part, or the complexity that arises here, is we mentioned earlier that the state portion of the rate is going to be destination based. And that applies really to local rates pretty regularly as well. But the little nuance is if you have intrastate sales taking place, so I'm a business, I'm located in Austin, Texas, and I'm selling to a customer in San Antonio, Texas, the destination will be the state rate. I'm sorry, for the state rate purposes, it'll be the destination of the 6.25%. But we actually don't use the destination to source the local piece of things. So if San Antonio's rate is 1%, but I'm in Austin, I think I said, and Austin is 2%, I would actually use the origin to source the local rates. So some complexities that arise on that front of whether or not it's all destination or some destination, some origin sourcing is something that needs to be considered. And really to further complicate this, and I made a comment about this early on, is with our type of industry we're talking about here, it's very common practice to have multiple users in multiple states associated with one invoice. So I'm in Georgia and I'm selling to a company that has subscribers to a SaaS platform in multiple states. How do I go about sourcing that? So we'll address some of those options in the next slides. All right, MPU sourcing. So what is MPU? MPU is a multiple points of use sourcing. So the best, easiest answer for our seller is, if I have a customer that's going to be located in a state that has a multiple points of use exemption certificate, then I would collect that from the customer, and then that would exempt all sales. So what is the certificate? Where do I get it from? There's only a handful of states that have a multiple points of use exemption certificate. And again, it has to be instances in which a customer has subscribers or users located in multiple states. If they're located in multiple states and the customer is based out of, say, like Ohio, then that customer can provide you as a technology vendor this multiple points of use certificate, and then you are off the hook of collecting the sales tax. No obligation to collect it all. Now, that doesn't necessarily mean, so what happens is that burden shifts from you, from collecting sales tax, to your customer, who is now required to report use tax. When the reason why a customer would be interested in doing this, though, is what if 90% of the customers' users are in Georgia and that Georgia doesn't tax SaaS, and only 10% of the users are in Ohio? Then only 10% of the sales price is going to be subject to sales tax or subject to use tax. So there is a benefit to the company that is providing the certificate, your customer, and then also a benefit to the company who's making the sale, because then there's no obligation to collect and report the sales tax. So what happens though if they're one of the many states that actually don't have that MPU certificate? So what are the options for sourcing revenue then? So we got a few questions here and a couple different options. There's really a best option. So the option to choose is really just based on the best information that you have available. If you have connected with your customer and found out they have users located in states A, B, and C, and then you can use that information to source your revenue. If you just find out just percentages of users located in these states, you can source that revenue. How do I document this? There's no formal process, no documents to actually, or forms to get from the Department of Revenue. It's just email correspondence that typically takes place. You may get an Excel file, lists out all the actual subscribers, their states, and then you just do some internal analysis to find out what's the percentage of users in each state. Should this allocation be updated? I mean, subscribers are going to be in flux all the time. So you may have customers or subscribers in, I don't know, 3 or 4 states in 1 month. It may go up to 6 states the next month. Some may fall off, some may be added. Should it be updated? Again, sourcing is really going to be based on the best receipts or the best information you have. So if you were to get all that information updated, great, use it. If you don't get it updated, work with the best information that you have. So what are some of the challenges if you do get that information? How do I invoice my customer? Do I need to send them, if they're in 40 states, do I need to send 40 invoices? And it doesn't really make sense to do that. So we still probably would send 1 invoice, but there needs to be some underlying record that supports the breakout of the revenue being distributed out on a state-by-state basis. So lots of complexities and system challenges that would likely take place in going that route. And that is likely why the vast majority of the users don't collect the best information that they can get and just defer to bill to locations, which is not a great answer. But from a functionalities perspective, many service companies, many software as a service companies just defer to that route because the complexities of really being 100% compliant are very challenging. All right, so this is just an example. If we're just visualizing this, right? So we are in state A, where the vendor is selling the technology. My customer headquarters is in state B, and this is really the same route of the bill, using like the bill to location, right? We're only sourcing to one area, and state B is a rate of 9%. So we're going to end up having $100,000 sale and then collecting 9% sales tax on that $100,000 sale. So an extra $9,000 in tax. But if we had the system capabilities and we were diligent and ended up reaching out to our customers to find out, hey, where are your subscribers located? There could be a significant benefit to your customer, which makes your pricing better, obviously, because now we're looking at some revenue source to state C, which only has a 6% rate, much better than the 9%. Some revenue source to state D, no sales tax at all, even better. And then some source to state E here. So overall, when you compile this information and you perform the allocations, good amount of savings will take place for your customer. All right, so on to the second polling question that we have for the day. And again, just a reminder, we do have 45 seconds allotted to answer this. So go ahead and get your answers in as needed. Question is do you know how your company is tracking sales revenue sources? Answer A, yes, we have a system in place. Answer B, yes, but not sure how we are tracking. Answer C, no. Hopefully that's not the answer. And answer D, not sure.
This is a area of great opportunity for companies too, to do a review and look at their technology spend to see if they've overpaid taxes.
Exactly right, right? If you ended up sourcing revenue to one of these states that provides, actually, on the buy side, right? I'm in Texas.
Yeah.
I'm the technology company. I am buying software and it's coming to me, but the build to location's always been Texas, but I got users everywhere. Maybe I have an overpayment scenario. Definitely a good point.
Right.
All right, it looks like we're all set, and let's go ahead and move on to the next topic.
Awesome.
Yeah. So we got taxability of products and services. And for this section, we'll go ahead and transition back to Diana.
Great. All right. So let's talk about the taxability of products and services. So what is it that you're selling? It's critical to understand what it is so that you can determine if there's any variation to taxability. Now, if you're selling widgets, they're probably going to be taxable everywhere that has a sales tax. But when we're talking technology, there's so many different variations of what's service, what's actual tangible personal property or digital good, and how the states deem it to be a TPP or something that's more along lines of a service and not taxable. So it is critical to characterize those goods that you sell, those products that you sell, as what they really are. Part of that will eliminate risk. So if you're selling a bundle that includes some software and includes some services, then you may be at risk if the states deem that bundle to be a taxable item that should be taxable on the full price. It's important to document any of these determinations so that you can have that backup information, understand the contracts and agreements. A lot of times I'll talk to clients and I'll be like, so this thing that you sell, what is it? They'll say, I have no idea. I just work in the tax department. I don't know what it is. So then they have to go looking at, it's important to understand, read the marketing materials to see what your company describes it as. You can look on the website and then looking at invoices as well. So if we move on here to software specifically, software is has various tax treatment depending on the method of delivery, depending on the state, of course. If there's one thing that you take away from this is that none of the states are consistent across the board. But there is pre-written tangible software, and that's almost always taxable. And I don't know that we really have many instances of that these days. I'm sure there are out there, but think of those things of the good old days when you had a disc or a CD or something that was actually tangible that you put into a computer. Now, over the years, pre-written electronically delivered software, that's stuff that you would just download. Or custom software. So when you have a technology company writing custom software, oftentimes that's not going to be taxable. It's more like a service type transaction. And then, of course, we have software as a service. Software as a service is more of like a digital good, a cloud computing type of option. And that is taxable in 20 plus states, but it is exempt in some states. There's also platform as a service and infrastructure as a service. So there's a lot of variation when it comes to technology. So if we move on here, we're going to talk about software maintenance. And software maintenance is another subject that can be problematic when determining whether it's taxable or not. So for example, is it pure support? What is it that you're getting with that software maintenance contract? Is that just updates and upgrades to the software? Because as you know, there's always going to be bug fixes or upgrades of new features and functionality. How was the software originally delivered? That could have an impact on what the taxability is of that maintenance contract. Is it bundled with the purchase of the software? So when you buy the software, do you have to buy that maintenance, or buying the software includes that maintenance? And then is the software optional or mandatory? So there's a lot of nuance in determining whether something is taxable or not. Nuance because each state looks at it differently. So then there's additional ancillary services and considerations when you're looking at technology. So programming services, you may buy canned software, but you may have programming services, customize it to meet your needs. Installation, implementation, configuration, modification, the training, the consulting, all of that are things that you need to evaluate on an individual basis because they will have different treatment in different jurisdictions. You have to determine what is provided. And then understanding that taxability does vary. So you need a way to handle that. So when you're selling to someone who is purchasing it in multiple states, there, like Chris was talking about earlier, in one state it may be exempt, in another state it may be taxable at a lower rate than the bill to state. And understanding if bundling services together with a tangible personal property or tangible software is going to taint that transaction. So when you have taxable and non-taxable together in one bundle, many times the states will say that flips it to be a taxable transaction. It may be based on the percentage of that transaction, that service, if it's de minimis or if it's more than that. And then does breaking out the services separately reduce the tax? So looking at all of that and how invoices are structured and how billing is structured to the end client can impact what's taxable or not. So let's look at data processing and information services. If you look, they're very similar in what they provide. If you look at the includes here, the data processing, summarizing, computing, extracting, sorting, sequencing, or updates of data, whereas information services is collecting, compiling, or analyzing information. Very similar in what it is, but there is a difference. And then data processing is taxable in less than 10 states, and information services are taxable in more than 10 states. Is the information public or private in nature? Could have an impact on that. If it's for business use versus personal use, can have an impact on whether it's taxable or not, or if you're selling both. And then, of course, Texas is a great example of how the tax can be nuanced. Is if it is a technology sale in Texas, say like SaaS software or information services or data processing rather, it's going to be taxable on 80% of the sale price. 20% of the sale price of that transaction is exempt. So when you're billing your clients in Texas, you need to have the ability to invoice correctly for those transactions. Now I'm going to hand it back to Chris, talk about exemption certificates.
Alrighty. All right. So exemption certificates. So first off, what is an exemption certificate? What do I do with one? In the instance in which your company has Nexus in a state, so they do have that obligation to collect sales tax, and the business is selling something that is subject to sales tax, there is an obligation to collect sales tax unless an exemption certificate is collected. An exemption certificate is going to be a form that the customer is going to provide to you to support a reason why you have not collected sales tax. So you collect these forms from your customer, you store them away in your records, whatever systems and whatnot that you're using, and then you just hold on to them for future support to support why an exempt sale takes place. So what type of certificates are available and what can be collected from customers? It really depends on the scenario with your customer. If your customer is buying property or services for resale, then there may be a resale certificate to collect. If you're selling to a hospital, a state and local government, nonprofits, schools, things of that nature, there may be an exempt entity certificate. If you're selling to a manufacturer who's basically using your software as part of performing a part of the overall manufacturing process, they may give you an exempt use certificate. And then we've already talked about the multiple points of use certificate earlier. Lots of variability. Some states have a whole slew of different certificates that you can get, and some states combine these all into one. You just get a certificate and it kind of works for whatever you're using it for. You just note on the certificate like what the reasoning is. So one question that comes up pretty regularly when having conversations with companies that do make exempt sales. All right, I have the certificate. Does it expire though? Do I have to go back and keep getting more and more of these things? And of course, lots of inconsistency across the states. I will say the majority of states, well, not the majority, it is the majority, it's a good chunk of the states, they will allow you to keep a certificate on hand until it is actually revoked by the customer. However, there are also a good chunk of states that are going to give you an actual date. You have to get a new certificate every year. You have to get a certificate every 5 years. So if you did your diligence and you went about collecting a certificate from a company and that certificate has been sitting in your box, your folders and whatnot for 10 years, you may have some expired ones. So if an audit was to take place and they looked at the certificate and they say this thing's expired, there may be some risk. So if there is risk, of course, you can reach out to your customer again to get a refresh, get some more certificates. But what if the customer's not a customer anymore? What if the customer's not in business? It's important to kind of stay on top of this as a business to prevent the creation of risk.
One thing I hear a lot from customers is they'll say, we're a wholesaler, we don't collect any certificates.
Yeah, I mean,
Because all our sales are for resale.
right. And I will say that, and everybody's always just like, or it's the flip side of that, right? Yes, we have the certificates. Oh, do you though? Really?
Yes. Yeah.
So in case you start like probing on that and you end up the answer to, in case you probe on it, then you find there's gaps. And on the reseller, the wholesaler, it doesn't really matter, right? If
Yeah.
you are selling something that is subject to sales tax, your only armor that you have to prevent from potentially being assessed is the collection of resale certificates.
Exactly.
If everything's for resale, from like you're selling to your customer and your customer is doing everything buy for resale, you still have to collect everything. You still have to collect certificates. There's no need to create the unnecessary risk. And there's all kinds of tools out there that actually help support this and make this a lot less painful, because if you're doing this on a manual basis and you have a significant customer base that is exempt, then yeah, I can understand why this is a bear and people are like hesitant to go through this process. But if you're using tools such as exemption certificate management through Avalara, then it just makes the whole process so much easier. So if you're using the software and you're asked, hey, do you have all the certificates? Let me look at my dashboard. My dashboard will tell me where my gaps are, right? It'll say, We got 80%, we still got 20%, we got some expired. Let's automate the whole follow-up with customer process so we can refresh these and keep these certificates valid. All right. So a couple common issues that people end up running into as part of the certificate process is, one is during the initial collection, and then two, which you've already just discussed a moment ago, are they still current? But as part of that initial collection process, are your certificates, is it the right state that you're receiving a certificate from? If I'm drop shipping a product, am I receiving a certificate from the bill to on the invoice or the ship to on the invoice? Is the certificate signed? Is it complete? Is the customer, should the customer really be providing us this? Are they really reselling product? So all kinds of little trip ups that could happen as part of the validation process. All right, polling question 3 here. So is your company actively collecting exemption certificates? And just as we said a minute ago, yes, of course we are. We got them all. Or option B, no, we are not collecting certificates at this point. Maybe something that should be considered in the future. And then option C, not sure. But it is surprising though. I mean, there's so many companies out there that I go through due diligence all the time with companies. And as part of going through this due diligence process, this just comes up all of the time. And you don't want to be in a time crunch through due diligence where you have to reach out and get all these certificates, and then companies are hesitant to get them back to you because it does require some work. Just creates unnecessary risk. All right. Well, I think we're getting there towards the end of this one, and looks like we're good. So let's go ahead and move on over to Diana and tax engine automation.
Great. So talking about tax engine automation, there's different ways to manage the compliance process, but currently it is a significant expense for a company who has someone doing it manually. Oftentimes with the clients and the customers that we talk to, they don't have a full sales and use tax department. It's somebody's part-time job. So there is some cost associated with it when you're doing it manually. But as the complexity of taxation increases across the board, and there's more consequences because you have exposure in more states, there's a lot of data that you need to correctly file each month, each quarter, and have that audit trail there to support you. And then it's not necessarily cheap because there's hardware, there's cloud services, there's automation software packages. So you really need to be able to effectively plan in association with your ERP or your billing platform to make sure that you can cover this aspect of your business, capturing that sales and use tax, calculating it, reporting it, and remitting it, to take advantage of the technology that's out there. So let's look at some of the pain points that some of our clients see. And that would be, if you have customers that are making sales online, the last thing you want to have happen is get an abandoned shopping cart. So you need to have a solution that's going to give you the speed and the calculation of that tax, so you don't have loss of sales due to a latency that the transaction isn't calculating, isn't providing that tax. Also, you cannot even begin to talk about anything technology related today without talking about the security aspects. So understanding when you're sending data outside of the network, what the requirements are. If you're dealing internationally, there's even more stringent data requirements that you need to comply with. Also understanding that you need to be able to access this information 24/7. So you need a solution that's going to provide you that uptime and reliability. If you're an e-commerce seller, you cannot have your website going down back to school sale week. So you really need a solution that's going to be timely, reliable, and have that uptime that you need. Finally, when you're looking at your solutions, you want to look at something that's going to integrate well to the systems that you currently have. So you don't want to have to utilize a lot of IT resources to develop a custom integration to a solution. You want to be able to plug and play as much as possible, or adding in an integration that was built for whatever platform you're on, whether that be your e-commerce solution, your ERP system, any other billing platform, your POS system. So looking at the ability to take advantage of integrations to your existing systems will minimize that cost on the technology side of it. So let's look at the benefits. When it comes to the benefits for sales and use tax automation, first and foremost, you want to be able to have something flash up and tell you, hey, you're approaching your economic nexus threshold. So being able to track your sales and add jurisdictions where you want to register with just one click. And then the product taxability, having that updated. There's so many changes that occur every year. There's over 100,000 changes in the rules every year. So you want to be able to stay on top of that, and anytime that change happens, it automatically occurs in your calculation software. Jurisdiction assignment, as Chris was talking about, sourcing those transactions to the correct tax jurisdiction is critical. So you want to be able to do that. We talked a lot about exemption certificates. What about W-9s as well? You want to be able to store that information centrally and easily accessed under audit. And then, of course, state and local tax prep filing, preparation and filing. You don't want to do it. I always joke that I love doing my job because I don't have to file sales tax returns anymore. So having a solution that can assist you with that is critical, and always having that data information for an audit, so you have that audit readiness. There are going to be audits, so you need to be prepared. So let's go to Chris with sales tax returns.
All righty, thank you. And all right, so this is more of a process related section of the actual review, and where we'll talk about, so in order to report sales tax to a jurisdiction, there are certain things that need to take place. One is a business will need to register to actually collect, to receive a sales tax permit. After a permit is received from the State Department of Revenue, an e-file account will be created. Through completing these two steps, there will be a functionality or a process available for a business to actually collect tax and report tax to a Department of Revenue through the appropriate filing periods. So a few different questions that we receive on a regular basis as when it comes to actually the filing of the returns. So how frequently do I need to file? Well, it depends on generally the amount of taxable revenue or sales tax that's going to be collected from a company. And these filing frequencies vary. Sometimes you'll start out with, say, a monthly filing frequency, annual filing frequency. Sales start ramping up for the business, and then the Department of Revenue says, all right, you're at a more regular filing frequency now. We need to move you from annual to quarterly. And sometimes you'll end up getting a monthly filing frequency. So you may have instances in which you're filing 12 returns a year in certain jurisdictions, and you may have certain instances where you're only filing one return per year. And then the question is, of course, what if I don't even have any sales for a filing period? I'm a software as a service provider. We have quarterly subscriptions, or every 6 months we bill our customers. Do I really need to file these $0 returns through all those periods in which I had no sales at all? And the answer is yes. If you don't file the returns, you don't address these periods and file these $0 returns, you will receive notices from the Department of Revenue. And the Department of Revenue will likely estimate the amount of tax due, will likely assess penalties, will likely assess interest. So there is some risk involved of not filing returns. So what happens if a customer asks for a refund of sales tax that I've already reported? That is a common situation, and there are a few different options. Optimally, the simplest approach would be you refund the tax back to the customer, and then you just take note of the credit and apply the credit as an offset on a future return. So you carry that credit forward and apply the credit as needed. But there are a few other options as well. If you don't ever expect to even get to use that credit, you don't want to refund it and just carry the credit forever. So maybe you need to amend the return. You amend an historical return that was filed, and then collect a refund from the Department of Revenue, and then return the refund to the customer once the actual refund has been processed. And then the other item is you can always file a refund claim as well. If a customer comes back and they want a $30,000 tax refund, and you're not feeling like, I can support providing a $30,000 tax refund after this has already been reported to the Department of Revenue, maybe I file a refund claim. It depends on the states too. Sometimes you file it, sometimes your customer has to get an assignment of rights and then they can file it. Optimally, your customer can deal with themselves, but some states won't allow that. So in those situations, you file the refund claim, work with the Department of Revenue. Department of Revenue eventually asks a few questions, they process the claim, you get your check, but then you hand it back to the customer. And what are some of the best practices? So, two of these really come to mind. You do need to have a filing calendar. It needs to have something that somebody can pick up, and then they can say, here are the states I'm registered in. Here are my login credentials to get to that state, my ID and my password. Here is my sales tax permit numbers. Here is the filing frequency. I got to do this on a quarterly basis, annually basis, just to make sure things don't fall through the gap or fall through the cracks. In addition to having that filing calendar, documenting processes is very helpful as well. If you document the process and it discusses where do you get the sales at, who are your point of contacts you need to connect with, what are critical dates that need to be met, just documenting it so somebody can come in and just take a look at this process and they can pick it up and go in case you're not there one day. All right, remittance of sales tax to the authority. How do I remit tax? And we had talked about earlier that in order to file these returns, you need to register and register for a permit, and then get an e-file account set up. And as soon as you set up that e-file account, as soon as you complete that sales tax registration and get your permit process, the state is going to start opening up periods, meaning that you'll have typically like links that show up in the e-file account or the Department of Revenue website, where I have to report sales tax for this particular period. So all you really do is you go into the Department of Revenue website, log into their e-file account, click through the links, and then you address your filing period. And in there, you'll input all the information that's necessary. You're reporting sales to jurisdiction, this city, that city, this city. Here's the taxes collected. Here's my exempt sales. You just feed all your information, all your reporting and whatnot into each individual Department of Revenue as required. And then after you submit your return, then you'll actually make the payment. And then this will be obviously a reoccurring process that takes place depending on the filing frequency assigned by each state. The good news is that one question I get regularly is, what about the local taxes? Do I have to file all these returns with all the cities and the counties as well? There are a few states that are pretty bad about that. And some states, yes, but some states, vast majority, you're going to submit one return to a state. You're going to make one payment to a state, but the reporting shows the amount of tax that goes to each jurisdiction. So while you pay the state, then behind the scenes, the state will distribute the revenue. So you're not going to be filing 20, 30, 40 returns in a jurisdiction if you have customers in 20, 30, 40 different cities. Unless we're talking about home rule cities, which we won't really get into. That's another animal in itself.
So much fun with home rules.
Exactly. All right. So this is my final slide here. So when it comes to actually filing returns, like what does a business have for options? One, obviously, let's just take care of this in-house. It's the least expensive way to do it when it comes to expenses and things like that. I got more control. I can file this thing and make adjustments however I see fit. I can be flexible on the dates. I'm not in more of I need information by date A, filed by date B, and all that stuff. So just a lot more in-house control. But there's also an option for outsourcing. If you don't have the resources to dedicate somebody to spend all the time to process the data, to prepare the returns, to file the returns, to address the notices and all that, then you can outsource this. Through outsourcing it, it takes away that mundane task that gets done on a monthly basis, quarterly basis, depending on how the filings, and allows staff to really focus on more of the value adds. Do I have Nexus here? Are my sales taxable? Are there questions I need to address for particular customers? And also, when shifting it to an outsourcing arrangement, then you outsource to people who do this stuff around the clock. That's their thing. They do it all day, which I can imagine. That's not my thing by any means. But
Been there, done that. Don't want to do it again.
Exactly. But they got expertise in it too, right? So they have
Yes.
their expertise, and they're there for technical support. You have the relationships and whatnot where you work with these people on a regular basis. They become familiar with the company. They identify like, okay, I see you've been filing low dollars for a long time, but all of a sudden we have a $50,000 return. What's up, right? So something that the filer would look into. All right. Final slide before we get to our last polling question, and this is one's to Diana to discuss partnering.
So with partnering, we work with firms to provide our solutions. So you can work with Chris and he can do all of the consultative activities for you, and then he will help you implement AvaTax and get that system going to make it easier for you. So Cherry Bekaert's been a great partner of ours. We partner with firms and we are happy to be here today to work on that partnering with you. And then I guess we'll move on to the polling question.
All right, so last question here, and then we'll wrap this up. Again, 45 seconds to complete. Would you like to learn more about how we can help moving forward? Answer A, yes. Answer B, no. And answer C, maybe in the future. Well, I think hopefully this was a fairly informative session for everybody. Diana and I work with technology companies all the time, just a reoccurring thing that we do. And there are so many businesses out there that have just been focused on growing and growing and making sales that compliance is just not a focus area at early stages of a business. So it's just nonstop new businesses coming in. So if you have issues, high likelihood that Diana and myself have seen these, and we have solutions to help out with any compliance needs.
Absolutely.
All righty. And that leads us to our final slide here. If you do have questions, it's been our pleasure being here. Again, my name is Chris Grimes, work at Cherry Bekaert. And if you have Avalara questions, Diana is on the list here. Email and phone numbers on the bottom. So just let us know if you have any questions.
Thank you.
Thank you very much.